Thank you everyone for your attendance. I really appreciate it. I am Sensei Kevlar, and I am here to talk to you about the way of the trader and the mindset of a profitable trader. I'm going to start with a quick review of what we covered yesterday. I'm just going to bring over the same worksheet that we were using yesterday. The basic idea of a profitable trader is a profitable trader will plan the trade and then trade the plan. And the reason for this is he can prove that by doing this, he can be profitable. I've found no other good way of ensuring such things, and if you find a good one, please let me know. Because when I do this, I like to ensure my profitability and my ultimate long-term success. So what I do is I plan the trade, and then once I have planned that trade out, I trade that plan. So what does a trade plan look like? The idea is that we are going to study the charts at different time frames and look for different patterns and see if we can identify past patterns that might give us indicators about what the market is going to do. Once we find a pattern, that should indicate to us what we can expect the market to do next. Once we have an indicator, we can make a case for a position. We can say, this indicator is telling me that the market is going to go up or down. And then using a series of indicators, we can make a case that, this tells me that it's going to go up, this tells me that it's going to go up, this tells me that it's going to go up. And I have all of these indicators, which in the past, when they've told me things are going to go up, it's gone up, and so I think it's going to go up. And I can prove this by going back and I can look, when all of these conditions have been met, did it go up? And is that true? And I can form a strategy around this. And then I can test that strategy moving forward. In the future, when this happens, if I were to have placed a trade that says, it's going to go up, did the market in fact then go up? And finally, of course, once you've proven that this can be successful, I recommend that you make those trades. The idea is when you're making trades, you're doing all three trades at the same time. You're putting in both your entry, your exit for your target, and your stop loss, where you're accepting that it's gone against, the market has gone against you, and you're turning your position around. So for example, if we have a 240 long, we're going to buy, we're going to sell at 244, we're going to, and accept our stop loss at 238. Then we're going to put all three of those trades in at the same time into the market. And when we hit our sell, we're going to cancel our stop loss. When we hit our stop loss, we're going to cancel our sell. The other thing that we talked about briefly was money management. When you're dealing with, you should always be dealing with some percentage of your portfolio. I use 1/10 of my portfolio, and I treat that as one position. So if you have $1,000, that's one position, and you can double up on that for big trades. We spent a lot of the time yesterday looking at doing studies and looking at support and resistance levels. Support and resistance levels being when the market comes down and it finds a point where the market is willing to support this price, the market buys back in and it pushes the market back up. When the market goes up and the market finds a level that it is no longer willing to not sell and take profit on, we call that resistance, and resistance pushes the market back down. Okay. So what we were finding yesterday was when the market moves, a lot of the time it moves on support and resistance levels, and I'm just going to call those out here. Here's a classic support, or here's a classic support level right here. And what I noticed in just doing a basic study of this chart, which is kind of where we're starting, every single time the price comes down and it meets this support level 3 times, it goes up again, and that would provide me a signal to buy back in. Okay, so what we're doing is we're looking for support and resistance as an indicator, and let's see if we can make a case for using support and resistance as an indicator, and see if we can build support for our case of going on a long position whenever the price comes down and meets the support line and gets pushed back up 3 times in a row. Let's see if we can do that. Well, let's start back here, right? The first time it came down and it went up, came down, went up, came back down, and then it went up again, and then it went way up, okay? So that's a pretty good start right there. 3 times where it came down, found support, didn't, came back to support, and then it went up again. So that tells me on that third time that it finds that support, that's a good indicator to buy and go long right there. So let's test that further. Let's back test that, right? Here's another case where we came down and we found a support level, and then we found that support level again, and then we found that support level a third time. Well, if I had bought in right here, look at where I could have exited, right? This is 215, this is 256 right here, right? That's some serious gain. This is 214, this is an easy 256 again, no problem, okay? So again, the market is telling me that when I go down 3 times and I test this support, I can go up and then expect some gains, right? So this third test of support forms a pretty solid signal. So let's keep trying that. Let's see what happens when we do that. Here the market found some new support, right? So I'm just going to put my line right in there and bring that line to meet that second support line right there. Okay. So let's see what happens, right? Let's say that I'm looking at the charts and it's today. This is today. This is all the more information we have at this point. And we've gone, oh look, right? It's come down and it's found a new support line. And it's come down and it's found a new support line. I think that if it comes down and it finds a new support line, I think that's a strong indicator based on my back testing that this is going to work for me. So now it's today and I'm going to future test this. So on paper, I'm going to wait for it to come down, and then a little while later, sure enough, look at what happens. It comes down and it tests my support a third time, okay? So on paper, I'm going to go ahead and I'm going to buy in and go long at 233. We'll just call it, we're just going to use nice round numbers here. We'll call it 233. We'll do a market buy, right? And I think that, this is a good thing, and I think I can expect probably, 250 easy in terms of my exit right here. And in terms of my stop loss, well, here's my stop loss right down here. I'm going to want to put this just under here. So 208 is probably a good stop loss for this, right? I want to put it under the current resistance in case it comes back down, right? And I want to be able to take my profits right up in here where previously it's turned around. I don't want to get all the way up here. I don't want to miss the bus. So I'm going to go for 253 because that's a nice reasonable. I think that these levels these resistances have been supported in the past. Okay, so then we'll play that out and see what happens. Bam, 253, perfect. Man, we are making money today, right? If we had traded this signal so far, right, we would have made all kinds of cash. We would have made cash, all February, half of February and half of March, right? We've been making some serious profits here. This is fantastic. We're really excited at this point. Okay, let's do this again, right? Fine. Okay. Well, it looks like it's found a new support level here, right? It came up and it went above, and then it came down and it tested it, and it came down and it tested it, and it went back up again, and it came down and it tested it. Okay, 252. Great. I'm going to buy in. Here's my 252 going long. Here's my below 233 for my stop loss, so we'll call it 228. And I'm going to target 280. Yeah, right up in here, 280, where this thing goes, right? Bam. Man, I am just making money every day, right? This is wonderful. This is working great for me, okay? So now the market just goes along a little bit, and I'm like, oh, look. It's finding some new support lines here, right? Okay, let's bring in some more horizontal lines, and let's just make some more money. No problem, right? Okay, so here we go. It went above 267, came back down. Went above 267, came back down. Went above 267. Man, I'm buying in, right? I think this can go all the way up to 292, right? We put our stop losses somewhere down in here, right below these lines. Let's draw these resistance lines. Sorry, these support lines. We want to put our stop loss just below this, like so 241, and we're targeting almost 300 on this trade for our long position, right? Okay. Bam, there we go. 296, perfect. Man, we couldn't have called that one better, right? We just made so much money over the past month. This is working fantastic. All right, let's make some more money. Keep doing this. Man, if this is making you money, keep doing it, right? But let's keep going and let's see what happens, all right? Here we go above, we go below, we go above, we come back, we go above, we come back a third time. Okay, man, let's do it again. 291, we're going long. We're going to put our stop losses well below 267. Here's 263. That looks like a good place for our stop loss. In terms of our profits, it looks like looking like 315 is a pretty good level for our previous resistance. Let's bring in that line right there, right? So we want to put it somewhere under 315. Looks like there's another point of resistance right here. So let's say 308. Let's call 308 a happy target to go from 291 to 308 and make a nice long profit on that one, right? Okay, so here we are, and we're gonna place our buy orders here at 267, right? And let's see what the market does, right? I'm sorry, we're gonna put our markets. We're here at 291. Let's see what the market does to us. Well, that didn't exactly work out the way we wanted it to. All right, so here we are back at 285. We're not yet below our stop loss. Okay, our 264, 263 stop loss below our previous resistance level. But we're definitely not headed in the right direction. But that's okay. We've got the strategy for this, right? The idea was that we can, double up on our position. So if we started at 291 and then we double up at 285, our average position is somewhere around 288, roughly. It's halfway in between. Okay. So if we went long for $100 here, we can go long for another $100 here. And our average position is around 288. Okay. No problem. We're still looking for that 300 easy, 288 to 300. I'll take my money. Thank you very much, and I'll walk away, right? And then what happens? We just hit our stop loss. That's a problem. All right. So no problem. We made a bunch of money. We're okay with giving some money back. But, we like our signal. Our signal was making us so much money. So I think we should do it again, right? So let's see. Here's our new resistance line, or here's our new support line. Okay. We're going to say, coming down, going up, coming down, going up. No problem, right? Here's our third test. Absolutely. Make our long orders. Put in, 284 as our targets. 240, 232 as our stop losses. Oh man, the market is just punishing us today, right? We didn't quite hit our stop losses, but we're definitely not. See, we did, and there's our stop loss. Okay, so what happened? Well, it turns out that one indicator alone just isn't enough, and that's why this is important, right? One indicator alone just isn't enough. You really do need several indicators in order to make a case and build support. So as it turns out, this indicator that we were using before of the market going up and coming down and testing support lines 3 times, this is only a valid indicator when the market has very recently given off a bunch of money. Okay, if you look previously, this signal was working really well in situations where the market had just come down a bunch and then gone sideways for a little bit. Okay, you see what I'm talking about? It came down a bunch and then it sort of found its new support line, and it wasn't until after this support line had been established twice that this signal really became valid. It wasn't valid prior to this. If you look and you try to do this, it wouldn't have worked. And if you looked and you tried to do this, it wouldn't have worked. And if you looked and you tried to do this, it just wouldn't have worked. It wouldn't have worked. Over and over and over again, it would not have worked. It would have worked, however, given this other set of conditions. So what we need is another indicator to express to us when the market is in a position where this type of signal is valid. Okay, so we still believe in the idea that these 3 tests of resistance, this is significant because, hey man, it was making us money. It was doing well for us. We were doing okay for a while there. We were making all kinds of cash, and then it just wasn't working anymore. Okay, so what we need a way of measuring when the market has come up and when the market has come down. So I've talked to you a little bit before. One way of doing this is just to switch to a different time frame. Instead of the 4-hour time frame, you can kind of look at the 15-hour time frame, right? And you can kind of do a visual map and say, yeah, look at that. it has recently come down a bunch. Here's where the testing of our signal is working well, is in this area right here. So it works well when it's come down a bunch, and then our signal testing worked well in this area. But then as soon as, but then later on when it didn't work, the market had not come down a bunch, okay? But then later on when the market had come down a bunch, then it worked again, And so we can keep on. What we need is a way of indicating to us when the market has come down a bunch. This is actually the place we were just testing against right here, back in February, right, when we were making all that money in the beginning of the year, okay? So we need a way of indicating when the market has recently given up more than it has gained, okay? So another way of thinking about this is, instead of just looking at this in visual time frames, we can actually think about this in terms of moving averages. So the idea behind a moving average is, I'm just going to pull up another notepad here. Say that you've got, some data, and we're going to use our price data as our data set. We're going to make up some numbers. We're going to go 244, 245, 244, 242, 241, 246, 239, 237. Oh, the market's coming down. 234, 235, 238, and 242. Market's coming back up again. 244, 246, 244. Okay. Let's say that these are the closes of a series of candles here. So the market closed at 1 hour or 1 day or 1 week or whatever. It closed at 244. The next hour it closed at 245. Then at 244. Then at 242. Okay. If we were to just average up all these numbers, we could probably arrive at some average value for the market. But as it turns out, what we really want to know is more recent numbers rather than less recent numbers. We want to know if the market has come down recently versus if the market has come down over a very long time. So if we were to average all these numbers up, we would find, the price, the value over a long time frame. But if we were to use something like a moving window of an average, in which we only included some fraction of them, say 4, we're going to use a time frame of 4 for our moving window, what we would do is we would average these 4 numbers together and just add them together and then divide by 4. And then that would give us the value for this. Let's just do that really fast, right? I'm going to pull up a calculator. We're going to go 244 plus 245 plus 244 plus 242, and we're going to divide by, where's my division, 4, and we get 243.75, okay? 243.75, okay, is the average for that 4, okay? Now, if I want to find this number, I'm going to do the same thing, except I'm only going to include these 4 points of data, okay? So, starting here, 245 plus 244 plus 242 plus 241 is equal to 972 divided by 4. Now we have 243. 243. Okay. So what I'm showing you here is we can just keep on doing this over and over, add up these 4, divide by 4, then we'll get the data plot for here. Okay. What this will do is this will give us an average that is relatively recent. As we move down this time frame here, the numbers in the past won't matter anymore. Only the most recent numbers will matter. So what we're doing is we're creating a derivative of the price values that is time sensitive. As numbers fall, as numbers move into the past, they no longer become relevant in our study. Okay. So fortunately, computers are really good at doing these things, and I don't have to sit here and do all these stupid calculations in a calculator. I'm just showing you, the idea behind a moving average. Okay. So what we can do is we can use moving averages to sort of find more derivative information about the price, because if over a time the price is going down, this number is going to, move slowly downward. And if the number is going up, this number is going to move slowly upward, but it's not going to move up as fast as the actual price itself. So what we're doing is we're smoothing out the signal a bit. By creating this derivative, we're smoothing out the noise in the signal, and we're giving ourselves more of a true number of what the market is actually doing. We're kind of subtracting some of these highs and lows, and we're just allowing the average true range to be found. If you were to draw a line right through this right here, this would actually represent, the average with all of these highs and lows sort of taken out. So that's what we're really finding with these numbers here by using a moving average. Okay, so one of the things that we said, though, was we didn't necessarily want to find the moving average of the price itself. What we wanted to find was a moving average of has the market recently lost value, or has the market recently gained value? So instead of doing the average of the actual prices, I'm just going to label these. This is our our close price, right? Instead, what I'm going to look at is I'm going to look at the gain and the losses of the market. Okay, so how do we do that? Here, in this case, we went from 244 to 245, so we're going to call that a gain of 1. And then we went from 245 to 244, we're going to call that a loss of 1. From 244 to 242 is a loss of 2. From 242 to 241 is a loss of 1. 241 to 246 is a gain of 5. 246 to 239 is a loss of 7. 239 to 237, loss of 2. Loss of 3. Gain of 1. Gain of 3. Gain of 5. Gain of 2. Gain of 2. Loss of 2. Okay. Now what we have is we have the motion of the market and the direction of the market. We know that in this time frame it went up 1. In these time frames it went down a grand total of 4. Then it went back up 5. Then it gave off a bunch. Then it came back up for a while. Then it went down. Okay, so these are the numbers that we're actually more interested in creating the derivative signal for. Okay, so what can we do with these numbers? Well, the first thing we want to do is we want to measure, we want to create moving averages of these, right? So if we take the moving average of the past, 8 or whatever, that's 5 plus 1. 5 plus 1 plus 1 is 7 divided by 3. 7 divided by 3 comes out to about 3 and change, or no, 2 and change. And then the loss is the same thing. You're going to add these all up. You're going to divide by the number. Okay, so let's just do that really fast. Say 7 plus 1 plus 1 divided by 3 is equal to our calculator. 7 plus 1 plus 1 divided by 3. Sorry, 7 plus 1 plus 1 divided by is 9. Is divided by 3 is 9. Yeah, okay. 3, and then we want 1 plus 2 plus 1 plus 7 plus 2 plus 3 divided by, how many samples do we have? 1, 2, 3, 4, 5, 6 samples. 6 samples, 2.6. So our average gain for this time frame right here was 3, and our average loss, sorry, I'm doing the math wrong. I have to use all the samples. These are really zeros, okay? And put these in here to make this more explicit. Did the math wrong by using the wrong number of samples to divide by. When I'm doing my averages, you have to count those zeros. Let's try this again. Five plus 1 plus 1 divided by 8. Okay. 1 plus 2 plus 1 plus 7 plus 2 plus 3 divided by 8 is 2. Okay. This is our MA of the gain over a 8 periods. This is the MA of the loss over 8 periods. Okay. Now, what this allows us to do is this allows us to see that in this time frame, we definitely did more losing than we did gaining. Okay. So what we want to do is we want to express this in terms of a number that we can plot over a graph that makes sense to us. Okay. So here's how we do this. We'll say that the MA of the gain on our time frame divided by the MA of the loss on our time frame, we'll call that the relative strength. Okay, so let's plug these numbers in. 0.875 divided by 2, and our relative strength is about 0.4375. Okay. Now, what can we do with this? This is a number that represents if the average gain is higher than the loss, this number will be larger than 1. If the average loss is higher than the gain, this number will be less than 1. Okay? Now we can use a formula to plot a number that is between 0 and 2 over a range that makes a little bit more sense to a human, and that's, by shifting everything, you make 0 equals, or you make 2 equal 100 and 0 equals 0, and then right smack dab in the middle of that is 50, 50. So we can deal with this in terms of a percentage. Okay, so the formula for that is you take 100 and you subtract 100 divided by 1 and added to the relative strength. Okay, and what this does is this gives you something, and we'll call this the relative strength index. Okay, so if this is 0.43, this is going to come out a little bit like 43 or so out of 100. Okay, now what this allows us to do is we can see that 43 is below 50. So the market must have recently come down. Okay, this provides us with a way of looking at the direction of the market. Because if the number on the relative strength index is above 50, it's recently done more gains than losses. And if the number on the relative strength index is below 50, it's recently done more losses than gains. Okay, enough math. The point of this is that the relative strength index indicator will show you the direction that the market has recently gone in, whether that be gains or losses. Okay, so let's see how we can use this to our advantage. I'm going to add an indicator to my chart. I'm going to go to the built-in library, and I'm going to find the relative strength index. Okay. Now, the computer has gone ahead. It's just done all of this math for me. You don't have to do any of this math. I simply showed you this math so we know how we arrived at this number and what this number is telling us, because it's really important that we understand why a signal works the way it does. Okay. So, in this case, what we can see is that here is our RSI. Okay. Here is the 100 mark. It will never go above this. Here is the 0 mark. It will never go below this. When the market does a big move down, the RSI rapidly does a shift downwards. Okay, as the market moves sideways, the RSI also moves sideways. And when the market does a shift upwards, it also does a shift upwards. Okay, so what we're seeing here is what were the times when the signal, the previous signal, let's go back to our, we're looking at our hour chart, and we're going to look for that time again when our signal became valid. Well, as it turns out, our signal was valid, and let's make sure that we're in the right time frame here. Yeah, let's go back to February. Here's March. There we go. Okay, here we are at the beginning of February. Man, at the beginning of February, we were just making so much money. It was just crazy, right? The second half of February, here we are. Okay, the market had just recently given off a whole bunch. And as a result, here we are in this location right here, right? As a result of the market having recently given off a whole bunch, our relative strength index was right around, let's see, what is that right there? Right around 30. It had just fallen under 30. And at the times when the relative strength index was below 30, this signal was working really well for us, right? This 3 tests of resistance, when it had recently gone under 30, man, we were good. When we had, again, here's another case. We had recently gone under 30. This 3 tests worked well for us, okay? Now here's another case. Here's the 3 tests again, but we weren't under 30. And look at what happened to us, okay? So what I'm showing you here is that one indicator isn't enough to make a case. In fact, you really need, as many indicators as you can possibly get to support your case. And that's what I'm trying to show you, is when I start applying these indicators on top of indicators, they start to signal more strongly. The more indicators you have, the more strong a signal. So let's now forward test this, right? Okay, here's a case. The RSI was touching 30, man. Let's do this. We're going long, right? Win. Here's another case. The RSI was touching 30, 3 tests of resistance. Win. Here's another case. RSI was 50. Let's not take this and let's see what happens. I'm kind of glad we didn't. Okay. Here's another case. Now the RSI is back under 30, and we're doing 3 tests. Could probably turn that into, there's the win right there, right? Okay, so this strategy is actually testing much better than previously. And the reason being is now I've combined 2 indicators in order to strengthen I've used one indicator to strengthen the case of the other indicator. Okay, and it seems to work really well. So let's keep going here. Here's another case. We got the 3 tests. What's the RSI doing? Under 30. Perfect. Okay. Here's another case. Here's another case. The RSI is at 50 again. We're doing 3 tests of support, and what happens? That was the big loss for us, right? That one didn't work so well for us. Okay, so let's keep going forward, right? Here's another case. RSI coming down to 30. 3 tests. Major win. Okay. Here's another case. 3 tests. RSI is at 50. Did we win? No, we did not, right? That's the time that we bought in, and we bought in more, and it just fell on us. Okay. Let's keep going. We didn't buy in on this one. Why? Because the RSI wasn't below 30 or touching 30, right? Let's keep going. Here's another case. 3 taps, man. 3 taps on the floor. And where was the RSI at the time? Was it 10? Can we turn that one into a win? Yeah, we sure can. Okay. Here's another test. 3 taps right here. Okay. Let's say this is today, or right here. 3 taps. Do we enter this long? No. Why? Because the RSI is not at 30 like it was before. Do we win? Are we glad that we didn't enter that long? Yeah, we sure are. We sure are. Over and over and over again, if you follow this pattern and you backtest this, right? Here's another case. 3 taps. 1, 2, 3. Where was the RSI? Okay. Probably could have turned that into a win if you were careful. If you exited at 254, right? Because you were looking for, this is your support line. You're looking for an exit above your resistance line, or below your resistance line. Hopefully, if you're a smart trader, you're willing to take this profit right here. If you're willing to take a bigger risk, you can go for the next resistance line. Okay. What about here? 3 taps. What about the RSI? Nope, we don't take this trade. Are we glad we didn't take this trade? We sure are. Okay. What about here? 3 taps. What's the RSI doing? Can we make this one into a winner? Yeah, we sure could. Here's 250. Yeah, here it is above our resistance again. Absolutely, we could have made this a winner. This one too, right here, right? If we had put our stop losses down below this support line right here, we would have made every single one of these trades a winner. So far, this signal has not failed us. In backtesting, we have just made ourselves really, really rich on paper. And that feels good because now we have confidence moving forward, right? That when we come down here and look at this, right? Here's our 3 tests, right? 1, 2, 3. What's the RSI? Touching 25. Or touching 20, yeah, touching 26, right? Can we turn that one into a winner? No, we can't. That one's going to hit our stop loss, okay? So it doesn't always work, and that's okay. Can we make it work more often than we can make it lose for us? That's the trick. That's the question, right? So let's try it again. Here's the time, 1, 2, 3, RSI, down around 25. Yeah, we can turn the 220 to 230. It's 10. It's a smaller profits, but if you're willing to wait on it, there's 233 right there. There's a big win. Okay. Now 3 tests. Here's 3 tests. What's the RSI doing? Okay. It's almost like we could start developing a new strategy here. If we see 3 tests and the RSI is not, or it's above 50 or at 50 or above, this might be a short signal that we're about to come down again, right? So that's an interesting hypothesis. Let's go back test that for a minute, okay? Let's come all the way back to, let's just bring in the scale a little bit here. Let's go all the way back to February where we're making all the money, right? Here's a case where the RSI is nice and at 50, right? First test, second test, third test. What if we were to use this right here as our short position? Okay. Short at 297. We'll put our stop losses in at 306, and we're going to target 284 for our profits. Okay. You can see that that was an easy one. All right, well, let's do it again. All right. Here we are. 1 test, 2 tests, 3 tests. Here's our third test. Didn't get to wait for that third up. So what if we just do it here, right? Develop that strategy so we can turn it into a profitable strategy. What if we enter here, right? We could have made it work there. We could have, here's a third test of it. Where's our RSI? It's doing about 50. It was recently above 50. If I were to put my short right here, I'd put my stop losses at 302. Profits at 281. Yes, sir. Profitable trade. Okay, let's do it again. 3 tests right here. I see it, right? RSI going up. RSI is at 76. 3 tests of support. 1, 2, 3. Here's where we enter our short. Maybe we don't get the short in so quick. We get it in at 266. We'll call it 266. It's well below because we did a recent drop there and we didn't realize soon enough. So we'll put our short in at 266. Yeah. The market will support 266. No problem. We got to trade in at 266. Then it came up a little bit more, right? Can we make this work? Oh, yes, sir, we can, right? Here's our profits right here. Okay. This whole time I was making money when the market was going up just by following 2 signals, or just by following 2 indicators rather. By combining tests of resistance with RSI below 30, I made every trade except for one a profitable trade. Okay. And on that one, I hit my stop loss. So if my stop losses are the same as my gains, and I get 6 gains in a row and 1 stop loss, that's the same as 5 gains in a row. Okay, that's a profitable trader right there. Now, if you then double that up and you look for the anti-correlated signal, the inverted signal, where you have 3 tests of support and RSI is above 50 or was recently above 50 or is really above 50 and you did a short instead, not only were you making money when the market went up, but you were making money when the market came down too. You were timing the ups and the downs of this market with precision, absolute precision, and only one of those that I saw was a loss. Okay, now the idea is we have developed a strategy and we think that this could be a profitable strategy. So now what we're going to do is we're going to forward test this strategy. Okay, we're going to take it up to today and we're going to say, all right, well, what's the market doing now? Can I make money using this in today's market? Because patterns can change, and that's a reality, right? And whales can do vicious things to the traders, right? They can just move the market around whenever they want. Okay, so just at the moment, we've recently seen 1, 2, 3 tests, and the RSI was recently high, and it's at 50, right? If this signal were to be valid, I would be able to place a short right here, and in a couple of days to a week or two, I'd be able to take my profits right here at this lower support line right here. Okay, so that's what I'm going to do. I'm not actually going to place any trades in the market, and I'm certainly not suggesting that you actually take this trade. What I am suggesting is that once you have found a strategy and you can prove that it works on paper, go ahead and trade it on paper moving forward too. Don't just don't just assume that the market will continue to do what it's always done and that moving forward that will be valid too. Test it out moving forward and see if it works. And if once you are convinced that, hey man, this is a valid signal, not only have I seen it work in the past, but I've seen it work moving forward, and I have built up enough confidence in myself that if I plan the trade this way and I consistently trade this plan, I will be profitable. Even if the first 2 times out it does not work, I have built up enough confidence that the statistical averaging is if I keep on using this methodology, even if I lose 2 times in a row, if I keep on planning the trade this way and then trading the plan this way, eventually I will be profitable. I didn't see any questions in the chat and nothing in the question box, so I hope that this has been informative to everyone, and that I have demonstrated the way that you can take a study and use it to find indicators to make a case for a position, and then use multiple indicators in multiple cases to build for support for that position. Back test that, forward test it moving forward, and once you are confident that you will be profitable by doing this, go ahead and be profitable. I hope to see everyone on Slack, on Reddit, on all the various places that we talk, and I definitely hope to see you again here tomorrow. Thank you very much.